in credit to the private sector is optimal for financial stability and then also for sustainable growth in a Romania banking sector system. So in our setup, since we want to benchmark what could be an optimal region of credit development, we will define the optimal region of credit development as the level where credit growth has positive impact on real economic growth. And I will justify later why this definition. So as I say, on the other hand, this paper is also related to foreign capital flows literature and the impact on banking sector development. Since foreign capital flows could influence domestic growth, but they also carry the risk of leading to financial stability when they are excessive and more reversible. So when one investigating what could be an optimum credit development region, we need also to consider what could be the impact of financial openness through these capital flows. So we know that international financial integration could influence domestic financial system through several channels. On the one hand, domestic bank in the wave of financial liberalization could borrow directly from international financial markets or multinational banks to finance their loan to domestic firms and households. So when borrowing conditions are more flexible in the international markets, those banks could increase their foreign position in terms of liabilities. On the other hand, foreign portfolio investors also in the wave of financial integration will be also able to purchase assets in stock market, leading to greater liquidity in those countries that open the market to these capital flows. So one investigating what could be an optimal region of credit development, we may need to consider also the impact that foreign capital flows could have on this optimal region of credit development. That's why in the second step we'll uh, investigate the impact of foreign capital flows in this framework. So in terms of theoretical perspective, you may need here to have a general macroeconomic model which incorporate the financial sector to be able to talk about what could be an optimal region of credit development. And in this domain, an interesting theoretical framework proposed by Idion and his co-author in the 2005 paper published in Quarterly Journal of Economics, where they investigate the effect of financial development on the convergence theory. So what is interesting in the theory is that the theoretical model predicts that the likelihood that a country will converge to the frontier growth rate increase with its level of financial development. And in a country that converge to this frontier, to the frontier of growth rate, financial development has a positive but eventually a vanishing effect on the steady state of GDP per capita. What is interesting in this framework is that it suggests that the relationship between financial development and economic development could be subject to non-linearities. And if this relation is subject to non-linearity, we may ask what could be an optimum region of credit development. So our theoretical framework we borrow from this theory, and in our setup, we will define the optimal region of credit development as the level where credit growth has positive impact on real economic growth. So we are assuming as a John that there could exist multiple regime of credit development, and the best region will be the region where any increase in credit development will lead to real economic growth. So we borrow from this adjoint theory to implement our empirical framework. And in this empirical, one interesting approach in this domain is the Panet threshold regression, pushing the literature by Ansen in his 1999 Journal of Econometrics paper, where uh, uh, the, this model will allow a regime sharing, where this model allow a regime sharing between two variable or other variable in the economy. So the model, the Anson model is like that. So in this model, you have YIT, which depend on ZIT, which is a regime independent variable. And then you will have XIT, which impact on YIT will depend on the level that a threshold variable QIT could take over time. So if we assume only that this is a model with air regimes, and if we assume that we have only one threshold, meaning that we have two regime, you have the impact of XIT, which will be captured by theta 1 and theta 2. So depending on the level of the threshold variable, the impact could change over time. So we'll use this empirical framework to check whether there exists an optimal relation of credit development. For that purpose, we will collect data principally for two sources, IMF, International Financial Statistics, and World Bank World Development Indicator for the relevant variable concerning this paper. So we have data for about 57 countries between 1985 and 2015. Initially, we had start with all countries and then check for the existence of continuous data about credit variable and real economic variable. And also we left out countries with population less than 1 million, high intensity conflict countries, and high institutional fragility countries. So we end up with 50, um, um, 87 countries between 1985 and 2015. So uh, in this chart, we have the distribution, the point distribution of the relationship between credit growth and real economic growth. And then the blue line is local polynomial fit of the relationship between credit growth and real economic growth. As we can see, the relationship between credit growth and real economic growth is partially linear. And that makes us confident to run our regression in the panel threshold framework. So basically, we will run this regression in this framework, assuming that there are a regime, and then do all necessary tests. And these tests are related are the F test, which will test whether slope are different between a regime, and the likelihood ratio test, which is based on bootstrap procedure to test whether the estimate value of the threshold is consistent with its true value. So running this regression, we found that there is three thresholds in the relationship between credit growth and real economic growth. So all F tests confirm this evidence. So we run our regression in this framework, assuming that we are three threshold. As I said, we start assuming that we are a regime, and the necessary test reveal that we have three threshold. So I will run regression in this framework. So these are the result of our regression. And in column 1, we have our base regression. And in this base regression, what we can see is that when credit growth is below -16, credit growth has negative but non-significant effect on real economic growth. So when credit growth is between -16 and 22, credit growth has the strongest impact on real economic growth. So a 1% increase in credit growth lead to 0.11% increase in real economic growth, real economic growth. And in the third regime, when credit growth is between 22 and 47, credit growth still has positive impact on real economic growth, but the magnitude is smaller than under the two regime. And when credit growth is higher than 47, credit growth has a negligible effect and non-significant effect on real economic growth. And in the column 2, we control for initial income per capita. Since in the literature we have papers saying that the impact of financial development on uh, real economic growth could depend on the initial income per capita, and then we control for initial income per capita and find that our results are still robust to controlling for initial income per capita. In the column 3, we control for gross capital formation. In the literature, we have also papers saying that the impact of foreign capital flow, the impact of credit growth of real economic growth could depend on country absorptive capacities. So we proxy country absorptive capacity by gross capital formation and find that our results are still robust to controlling for country absorptive capacities. In the column 4, we control for human capital growth, proxies year by population growth, and find that our results are still robust. You might recall that in the literature, there is paper saying that the impact of financial development on economic development could also depend on human capital. And then we control for human capital growth, proxies year by population growth, and find that our results are still robust. In the column 5, we control for all possible determinants of real economic growth in the literature and find that our results are still robust. So here, the main finding is that the impact of credit growth on real economic growth depend on the regime of credit growth. So under the first regime, credit growth has negative impact on real economic growth. Under the second regime, the effect of credit growth is the strongest one. Under the third regime, the impact still is positive, but smaller than under the second regime. And under the fourth regime, the gain for an increase in credit to economy became negligible. That means that not all credit growth will necessarily lead to real economic growth. And this paper echo some paper in the literature trying to say that. So in this table, we split country over time according to being in the regime 2 or regime 3. Regime 1, regime 2, regime 3, regime 4 of credit growth. And find that most of the time, country lay on the regime 2. What is interesting with this paper is that these countries which are under regime 2 could move into the regime 3, gaining additional growth by increasing uh, the, the, the real economic growth. That is what you find in since credit growth still has positive impact, but the impact is smaller than under the regime 2. So here, the first step, we have identified what could be what is an optimal ratio of credit development. So when credit growth is between minus 16 and 22, we have the strongest impact. And this impact is still positive under the regime 3. And hereafter, we will call the optimum region of credit development as the region where credit is within these two regimes of credit growth. So this paper echo the plea by Professor Murinde and Demetriades in the literature, suggesting to think about finance in terms of quality rather than quantity. Here, we are showing that not all credit growth would lead to real economic growth. And we may need to think about credit growth in terms of quality here rather than in terms of quantity. What could be for a developing country, what would be the best zone, the best region of credit growth? And here we are showing that the best region is where credit growth is between minus 16 and 47. So uh, these results suggest also that policymakers should put a buffer on credit growth so as to avoid being in the regime where credit growth doesn't have any impact on real economic growth. So, having identified this optimal region of credit development, we now investigate what is the impact of foreign capital flows on this framework, in this framework. So how do foreign capital flows impact on this optimal region of credit development? And for that purpose, we'll collect disaggregated data on foreign capital flows from IMF, International Financial Statistics, and these capital flows are FDI inflows, portfolio debt inflows, portfolio equity inflows, portfolio investment, which is the sum of portfolio debt inflows and portfolio equity inflows, other debt inflows, which is the net incurrence of liabilities in other debt instruments, which are not debt securities, other equity inflows, which are net incurrence of liability in other equity instruments, and other investment inflows, which are the net incurrence of liability in other instruments and for other um, financial corporation. So for all these variable will all these foreign capital variable will be scaled by GDP, and also will apply the inverse transform in hyperbolic transformation, which consists of using the log stars transformation instead of the log transformation due to negative value of some capital flows. So here we'll create three dummy as our dependent variable. So a first dummy, which will take the value 1 when credit growth is within the second regime. Recall that under the second regime, we have the strongest impact of credit growth on real economic growth. And a dummy here, regime 3, which will take the value 1 when credit growth is within the third regime. In the third regime, credit growth still has positive impact on real economic growth, but the impact is smaller than under the second regime. And then we will have a third dummy, which is a combination of these two dummies, which will take the value 1 when credit growth is within what we have called the optimal region of credit development. And since our dependent variable is a dummy, we will use panel logistic regression, and we will run regression for all countries in our panel, and then only for developing countries, since we can imagine that to some extent developing country, a country of destination of these capital flows, even though the recent literature document the increase of capital flows between developing countries. So we will run regression using our tree dummy and see whether the impact of capital flow depend on the regime of credit growth. So here we have the result for all countries in our paper, panel for the regime 2 dummy. Recall that the regime 2 dummy takes the value 1 when credit growth is within minus 16 and 22. And here we found that other equity inflows, here other equity inflows, and portfolio equity inflows have negative impact on uh, credit growth under the second regime. So for all countries in our panel, other equity inflows and portfolio equity inflows matter for the probability of being under the second regime. And here we have a result, the same result for only developing country in our panel. So when running regression for only developing country in our panel, we found that for all country, other equity inflow still has negative impact, but now portfolio debt inflows seem to have positive impact on credit growth under the second regime. So if you are a developing country wanted to be under the second regime of credit growth, you may pay attention to other equity inflows and portfolio debt inflows. So here we have the result with our regime 3 dummy. So recall that regime 3 dummy take the value 1 when credit growth is between 22 and 47. And under this regime, credit growth still has positive impact on real economic growth, but the impact is smaller than under the second regime. And when running regression for all countries, we find that other equity now and portfolio equity inflows uh, have positive impact. That means that uh, other equity inflows seems to drive credit growth under the third regime of credit growth for all countries in our panel. Here we have a result, the same regression for only developing country in our panel. And for only developing country in our panel, it is other equity inflows that matter. So if you are a developing country wanted to be under the third regime, you may need to pay attention to other equity inflows. Now, we have also a result now for our third dummy, which is one when credit growth is within the second and third regime simultaneously, and check whether the perspective of capital flows change. And when running regression for all countries in our panel, we find that there is no evidence that for foreign capital flows matter for credit growth. And when running regression, the same regression for only developing country using the same dummy in our panel, we find that portfolio debt inflows and portfolio equity inflows have positive impact on credit growth under what we call optimal region of credit development. So if you are a developing country wanted to be under the optimal region of credit growth, you may need to pay attention to portfolio debt inflows and portfolio equity inflows. Since these portfolio investment inflows are also known in the literature as those which are more reversible, you may need to some extent to put like capital control to a buffer on this kind of capital flow to avoid reversibility and being able to deal with this the negative outcome that can come from these capital flows. So to conclude, in this paper, we have identified an optimum region of credit development. This is when credit growth is between minus 16 and 47. And for developing country, for capital flows, we found that the impact of foreign capital flows depend on the type of capital flows, the regime of credit growth, and also the level of economic development, since we are different perspective when running regression for all countries in our panel and only for developing countries. So for developing countries, portfolio investment seems to matter for the optimal the credit development region, and policymaker should at least try to set up buffer to deal with negative outcome that could come from these capital flows. So this is what we found in this paper. And I would like to thank you very much for your attention. And as I said, this is an ongoing work. So all comments, suggestions, questions are most welcome. And Professor, the floor is yours. Thank you very much.
Thank you, Francois, for a very exciting and animated presentation of this paper. I love your style of presentation and the way you emphasize the key issues in a very, very clear, absolutely clear presentation in what is an interesting piece of work with an attempt to go beyond the standard work, because I see in most of the papers using threshold regression models of Hansen and others, just focusing on one threshold, but you actually go over the traditional and engage in multiple thresholds. So you've taken us one extra dimension. Getting data on 87 countries, which normally, very difficult, but you actually managed to do it. And come closer to almost a global sample, a world sample, of those countries. So this is absolutely interesting a presentation that also the motivation of being able to show, the literature, what are the gaps, and then weighing in the investigation is absolutely relevant. Okay, so let me open the floor to questions, comments. Please put up your hand. There is a raise hand button where you can click to show you have yes, and then we continue from there. So I can see comments from Dr. Thomas Bwile of Bank of Uganda and COMESA. And then I see also Oisha, our good friend who works actually in these areas, and also a couple of others working. So I'll take Dr. Thomas Bwile, then come to Aisha, and then continue. So, Dr. Bwile.
Thank you, Prof. And thank you, Franco, for such a wonderful, wonderful paper. Just to echo Professor's words, I think this is work that goes beyond the tradition. And it's mesmerizing to read and listen to. Mine is about the threshold level of credit growth. And I'm speaking from the perspective of developing countries. In monetary policy circles, credit growth is one of the key variables that we keep our eyes on. And that raises my question, actually, whether it is still possible at this point in time to capture something called a monetary policy variable. And this is the reason I'm thinking so. Many of the countries undertaking inflation target light have something called the medium-term inflation target. Now, what happens is, this is a number which is given. Now, every time credit, and of course there are these two objectives. One, you want to control inflation, but at the same time, you want to harvest the benefit of growth. You want the economy to grow, but inflation must be controlled. And one of the variables leading to, for example, high inflation is correct growth. At the same time, correct growth is fundamental for growth. Now, there is something we call overheating. And we use the word overheating very selectively because it depends on the inflation target you have over the medium term. So if a country, for example, has inflation target of 5% over the medium term, if credit exceeds 15%, that's extremely high for that economy. Now, I'm just inquisitive. If, for example, you captured this variable called monetary policy variable within that, if this threshold will still apply for those countries that have a medium target level of, for example, inflation.
So thank you very much for this comment and question. So in our regulation, we control for inflation change, but I didn't check whether any for all country whether they have a medium term. I'm assuming that maybe they have a medium term or a long term inflation target, and then I control for inflation change. That is the annual change of inflation for all country in our panel. So I control for inflation. I don't know it answer your preoccupation, but I control for inflation, but I didn't distinguish between country having, since country could have many targets. I think it will be difficult to check for all country in my panel for each country whether what is medium term inflation target and so on. So I just control for inflation. I don't know it could answer your question.
Well, I'm not asking you a question whatsoever. I'm simply
Ah,
saying, is there room you can consider this variable?
okay,
Because,
okay.
yes, because as far as I'm concerned,
Okay,
this monetary policy target and the credit growth
okay,
really are variables that we observe.
okay,
And I'm coming from the perspective where I think that sometimes we impose these targets
okay.
without doing rigorous analysis to establish whether the target that we have set is optimal or not.
Yeah, I think, Thomas, that's a very, very useful comment at the time of developing this paper, to show that, the credit growth may affect inflation. It also may affect other non-targets, including the trade-off between inflation and growth. So we thank you for this important observation. Could I call upon Aisha to give a second comment?
Hello, thank you very much, Francois, for your great presentation. And my question is basically on the methodology that you follow in your empirical estimation. So I would like to know how did you extend the existing model that is designed to identify one threshold to multiple thresholds, or did you use a ready available estimation codes to do that? And a second comment, actually, it's the second comment of is for the purpose of clarification. In your estimation outputs, it would be good if you include an information on what your dependent variable is, because you present several tables, but you didn't put any note on what your dependent variable is. So it may be hard for some of us to follow what you are estimating for, which variable that you regress and estimate in your tables. So it will be very good if you could explain how did you extend the model, threshold model, to multiple threshold models.
So thank you very much, Aisha, for this question. So in Starter, you have the code which could help to estimate the model when you have one threshold. But in Air, you can extend the basic code of Ansen to capture multiple threshold. And this regression I've done it by with Air.
And I have one suggestion, Francois. Actually, did you capture endogeneity in your model?
So this is an interesting question. Uh, in the Ansen and Kanner the 2004 paper, they developed a model with endogeneity. But what is interesting is that there have been another paper published by one of Ansen student, you
Kramer.
Philip, not Kramer,
Philip.
you and Phillips, published in Journal of Econometrics 2018, showing that when you have a strong instrument, what the instrument do, it improve your rate of conversions in the estimation process. But without an instrument, the threshold are well identified and the tests are well identified. So when you have Ansen code and could extend this code, it doesn't need again to check whether I have a weak instrument or a strong instrument, since in the paper of you and Philip, the the fact of having a good instrument, it improve your rate of conversions. So I don't have a problem of conversions in my data. So I was
Actually, for the dynamic models, because in the dynamic models we have the convergence term. So for these kind of models, this is actually just a suggestion. It is Kramer et al. 2015 who extend the panel threshold model to incorporate the convergence term and estimate it through sorting endogeneity. So this is just a suggestion, and I can send you the link if you want to incorporate endogeneity when dynamic models are used.
Okay, thank you very much.
Thank you. Thank you. Thank you, Francois.
Thank you very much,
Please.
Aisha, and also the response by Francois. It is reminiscent of the discussions that Francois used to have with Aisha at SOAS when they used to have neighboring offices last year and the year before. So thank you very much for this debate. I think on the thresholds, and of course, the other comment, which on the presentation of tables and showing the endogenous variables, very helpful and timely. Okay. Dr. Andrew Mwaba.
Thank you, Victor, and thank you, Francois, for this well-done paper. Very concise presentation. I just have two small comments. The first one is goes to your last point that, especially for developing countries, they could employ some buffers to put in place to make sure that some of the bad effects of the capital flows are arrested. What are those buffers? We can give some few examples. And then my second point is whether you took into consideration to include political economic factors such as governance when you are running these models, or are you assuming that it's a constant? Because they have an impact on capital flows, especially foreign savings. Thank you.
Thank you, Andrew.
So thank you very much. I didn't understand. Can you please repeat your first question?
Okay, the first question, the last point you made in your presentation was that
Yeah.
countries can employ buffers
Okay.
to lower the effects of some of the inflows. So I just said, what examples can you give for those buffers? Yeah.
Okay, thank you very much. So, if for those countries in my panel, maybe I would suggest to have credit growth between 0 and 47. I'm assuming that maybe the negative credit growth are linking to the fact that precedent period maybe credit growth was so high that in the second time it has been reduced. So maybe for country in my panel, I will suggest to put buffer in order to have credit growth between the optimal region of credit development. So for your second question, indeed, uh, I need to consider governance indicator, but the problem I have with governance indicators is that even for the World Bank in development, world governance indicators and PRS group um, database. I don't have data for that cover my period of analysis. And in the threshold framework, you cannot have an unbalanced panel. We cannot deal from now. We cannot dealing with missing data in panel threshold regression. That's why I didn't include them. But in the second regression with capital flows, I could include them. Governance indicator, of course. So thank you very much.
No,
Yeah,
thank
yeah.
you.
Let
Thank
me
you.
also add my thanks to Andrew because he raises two, very critical points, especially from the perspective of a central banker, that you would be looking for the nature of the thresholds, right? The maximum and the minimum levels in which you can let your credit growth, move. It's more like a snack in the tunnel. And of course, Francois, we need possibly to not sanctify so much the result, but put a kind of a caveat that these thresholds have been determined from historical data. Okay, and it may be it's a kind of a Lucas critique, really, that maybe for future planning, we can only do a simulation to see to actually confirm these levels. Okay,
Okay.
so that policymakers don't have to take it as a hard truth that they must, say move between 5% and 16%, but as a
Yeah.
guidance, that is where historically stability has been established. But that's a very, very important comment, from a central bank perspective on how they can take the results of the Francois innovation into policy and implementation. Thank you indeed. Dr. Rosingugi.
Yeah, thank you very much, Chair, and thanks, Francois, for the very rich presentation that you provided. I have two comments. The first one is maybe I didn't hear it from the beginning. What the credit you are looking at is composed of. Is it the private sector credit from the banking sector? Or is it a combination? Because we know there are situations where banking sector credit could be both private and public. And does it matter the thresholds when you consider the composition of the credit from the banking sector? That's my first question. The second one is asking the question whether it matters the economic structure. For example, there are countries where you may find the agriculture, manufacturing, trade, in terms of distribution of the credit, may mean different things. So in your analysis, is it possible to see the sectoral allocations of the credit and then check on the thresholds from that angle? And this also probably is to also think about countries that have more SMEs and those that have multinational big firms, which may make a difference between with the portfolio equity and portfolio debt. That MSMEs may not actually attract this portfolio equity, but having large firms, it could actually attract this. And then my third comment is to ask what is the channel for this non-linearity? Is it because when you increase credit growth, you increase the risk of default, which maybe one can check with the non-performing loans? And therefore, is there a way that you can actually try to bring in that credit risk and check whether it increases with the credit growth? I'm not sure whether the data is available, but I'm trying to think about it from that angle. And then finally, I'm looking at my situation in Kenya, that policymakers are looking for an increase in credit growth so that we can enhance investment levels. So, and the credit growth at the moment, they are less than a double digit. They are less than the 22% have seen there. So I'm trying to wonder how I would tell my policymakers that you need to check, or rather you need to rethink as far as credit growth is concerned. I'm still not very clear how I would communicate that information to a policymaker. Thank you very much.
Thank you, Dr. Rose Ngugi. I didn't introduce Dr. Ngugi very clearly at the start when presenting. Dr. Ngugi is the CEO of the main think tank in Kenya, the Kenyan Institute for Public Policy Research and Analysis. And that's why, these very important questions that would feed directly into policy. So, Francois, your response.
So thank you very much, Dr. Rose. For the credit variable, here we have credit to all sectors, excluding financial credit to other financial corporation. So in the IMF, you are credit to private sector. This is the line 22. And then you have credit to all sectors, excluding financial sector, which is credit line 32. What we are using here is credit line 32, credit to all sector, excluding financial sector, credit to other financial sectors. So for the question on sectoral allocation of credit, here we have aggregate data. So we do not have disaggregate data to be able to think about sectoral allocation. Maybe that could be an extension to see whether the threshold matter when you are using disaggregate data. Uh, for the question on the channels, from now, I think it's an interesting question, and I could think about this. What is the channel through which, since we are showing that not all credit growth could lead to economic growth, is there some of credit growth are linked to maybe credit growth which are not within the optimal region of credit growth? Is that credit growth linking to non-performing loan? I think this is an interesting robustness check that I can do. to check what is a good channel to be about to be able to talk about credit growth. So thank you very much for this suggestion. I don't know.
Yeah. Thanks, Francois, for that response. Yes, the disaggregated data would have been very helpful. By know that line 32, sometimes we find you have just aggregate, data. To go into sectoral differences, and the current work seems to identify in agricultural sector and services sector in areas of financial inclusion, they work on financial inclusion, but in the areas of as we are looking at credit and capital flows, I think the answer is, and it's very important for the paper. It could be a footnote, it could be discussed, but it's very important to say we can't get the insight. We can't get insight into sectoral differences in a single economy because we don't have disaggregated data. And further research looking at disaggregated may be able to address this question. Or if you had some regional commercial data disaggregated, you could apply the same model, same techniques, and get insight into the differences. The channel is also, I think, absolutely important. Then maybe it's something to explore. You said you're going to do some robustness checks, and maybe to see whether the interaction term can give you a channel, whether by using interaction term you can say, okay, credit works directly or works indirectly through a different channel. Could be a perspective. Maybe that's an extra table, regression table, to say, okay, we could explore channels of only through an interaction term. Okay, excellent. Oladapo. Yes, Oladapo, just while I'm used to introduce him, Oladapo presented an excellent paper at our reading group 9 to 10 this morning. He's investigating, he's in your footsteps, also very prolific, Francois. He's investigating macroprudential policy. I don't want to guess his question. Oladapo, you can mention your question yourself.
Yeah, thank you very much. Just like Victor has mentioned this morning about my presentation, I actually like what you've presented, because one of the biggest problem with macroprudential regulation is how to sell the ideas to the lawmakers. If you look at monetary policy as a framework as we see it today, there's been so much agreement in terms of what monetary stability is all about, because you have inflation as a variable which everybody is looking at. But for macroprudential regulation, we actually don't have a single variable that we can look at to make our judgment to say, this is, what we want and all of that. So I think it is very important to build into your to your paper monetary policy framework. I think that was what Thomas and I think Rose also mentioned, something like that, so that the idea can be sellable to lawmakers and also to policymakers. My question, that's just a comment. So my question actually has to do with one of the problems that we've seen in macroprudential tool design, and that has to do with the fact that there are heterogeneous factors at country levels. So the countries that you looked at in setting your limits, I think it was a combination of developing and developed countries, right?
Yes.
Exactly. So, and you came back towards the concluding part, and you were talking about just developing countries. So for me, I think, for the framework, for your paper to look agreeable, because Rose said something which was what I looked at your paper. I was like, 40%. Is there any country in Africa that can allow credit grow at the rate of 40% without overeating? I I struggled with that figure a bit. So what I'm saying is, in setting those your limits, can you just restrict the number of the countries to developing countries? Yeah, and let's see where the optimal credit ratio would fall, and then we can take it up from there. That's the question.
So thank you very much. So for your suggestion about monetary policy framework, I will think about that. But for country in my panel, let me explain that a little bit. What first we want to do is to benchmark what could be an optimum region of credit development. And in this way, we need to have developing countries as well as developed countries, since we want to benchmark. Otherwise, the benchmark would be only for developing countries. So at the first time, we benchmark what could be an optimal region of credit development. And in this way, we need to have all countries. Second, for the capital flows analysis, I run a regression for all countries in the panel and then only for developing country. Why that? Because to some extent, developed country could be country of origin, and then developing country of destination. And I just want to look what the perspective change when considering only developing country in the foreign capital flows framework. I don't uh, I don't know if I answer your question, but this is basically what we are trying to do in this paper.
Okay. All right. Okay. Thank you.
Thank you very much, Oladapo, and thanks, Francois, for that response. Sometimes it becomes important to even look at various groups of the sample, but I think you've done that. You have taken all the countries in one sample, and then you have a set of developing countries. So there are kind of the variations is already there, and could be explored in many ways, differently. Desiree Kanga. Desiree.
Yeah, thank you very much, Prof. Thank you very much, Francois. I hope you hear me very well. And
Yes.
This is an interesting presentation. My comment will be much more on econometric side, but maybe before that, I would like to suggest, I don't know if it makes sense to control for the monetary policy regime based on what Thomas said before. So maybe it can take into account some of the change in the policy regime. So my first question will be on the estimation you have done. So I will not come back on endogeneity because you already answered on it. But your model has been estimated assuming that one part is linear and that you have the threshold, and the threshold would affect, I think, one variable, something like that. Or you have full heterogeneity. I don't know if it's clear, but it looks like you have one linear part and one non-linear, and the non-linearity will come on the credit growth. But this will affect all the variables in the model, but or only one variable in the model.
Sorry, I didn't understand your question. Please.
Yeah, could you come back on your slide on the equation? Maybe I missed something. Yeah, if you can do it very quickly. Sorry.
That's okay. Meanwhile, let me thank you, Desiree, for meanwhile, Francois is looking for the slide. Let me thank you, Desiree, for pointing out that fact about exploring different monetary policy regimes, which could be done from the data, and therefore absolutely address the question of Thomas. Thank you. So So there's Francois, I think you're looking for the equation.
Yeah,
yeah.
Can you see my screen?
What I see is literature survey.
No. This is
Okay,
not the
can
right
you go
screen.
back?
No. This is not the right screen. Let me share the right screen. No. Sorry.
Are you able to go back on that slide, to go back a couple of pages on that slide?
Yeah. Let me just.
I think in the same PowerPoint presentation,
Okay.
but we landed on the, yes, exactly. Yeah.
Yes.
Yes. I think that's the one.
So
Okay. Desiree, could you go ahead? Hello, Desiree. I think Desiree may have a connection problem. Desiree Kanga. I think there is a connection problem with the Dr. Desiree Kanga. I think we can, hello? We can possibly, we can leave it at that. And there is a hand from Dr. Andrew Ngaba. Is that an old hand or is it a new hand, Andrew?
I think it's an old hand. I've been trying to pull it down now.
Okay, don't worry. I'll put it down for you. No problem.
Okay, please go ahead.
Thank you. Okay. So when Dr. Kanga comes back, we'll bring him back into the discussion. But it appears that we have lost connection with him. Any further comments? Athena, do you have any comments in the chat?
No, Victor, just people saying thank you or sorry for joining late or sorry for having to leave a little bit earlier.
They have to leave. Okay. Let me also acknowledge the presence of Dr. Kupkide Mulambo, the Deputy Governor of the Central Bank of Zimbabwe, who had is always a keen participant in these, seminars. Thank you very much for being with us. Okay, so let me see any further comments on the paper. Comments, questions. Okay. I don't think I have any hands up at the moment, or any comments on the in the chat room. Now, the question that Desiree was trying to mention is about combining linearity and non-linearity.
Sorry, Victor, I think Anosi has a question.
Okay. Anosi, please go ahead. Yeah.
Oh, yeah, thank you. And thanks, Francois, for the presentation. It's actually quite an interesting topic. During the presentation, I just had this thought about, where the flow of credit, like where the flow of credits has a role to play in this, in your study. So an increase in credit growth may lead to, cheaper money may flow into financial assets, not into the real economy. So, I don't know if you incorporated that in the study or how that dynamic plays out.
So thank you very much, Anozi. So as I said, it's a little bit difficult to incorporate that. This will mean that I have sectoral allocation of credit to be able to see whether credit go to financial sector, agriculture, and so on and so on. So I think it's this same comment with Dr. Rose, and I will check for this issue. Thank you very much for this suggestion.
Yeah, perhaps maybe you could use some kind of proxy from the equity markets,
Okay.
Something like that, perhaps.
Okay.
If you
Okay. So thank you very much. Thank you very much.
Thanks, Nosi, for that observation that credits could go into equity or acquisition of financial assets. I think we had a case study of Malaysia in the empirical work where that paper was showing that there was increased lending in the banking sector, but most of the lending was not going into productive activities for the sectors, but was going into speculation on the stock market. And that's where there was, increased borrowing, what Thomas was called overheating, but also the increased demand of shares on the equity market and overheating both markets. We can't be able to disentangle those phenomenon in the current framework, but we can put a footnote to say we don't think that this will draw. We assume that the credit growth will translate into activities for funding economic growth. Okay. Any other questions, points, observations? And I think Desiree seems to be on the.
Yeah, I'm in, but I don't know if you hear me.
Oh, you are back. Okay,
let me.
Yeah.
Okay, so I will go quickly. Maybe before coming on the.
Yeah, that's the.
Oh, okay, okay. Yeah, that's fine. I think I missed that one. I just want to check if but the beta in the first, assume that you have two regime. Your beta in first regime is the same as in the second regime.
And no, beta is a regime independent variable.
So it means that you have some variable that does not depend on the regime. So what will your estimate, your threshold will be if you assume that you have full heterogeneity, meaning that your betas may be vary between regime 1, regime 2, regime 3 and 4. Does we change your threshold? That's my question.
Okay, thank you very much. This is an interesting question.
Yeah,
I don't know how to deal with that because I'm assuming that all my dependent variable are regime dependent variable.
Yeah.
This may be hard to estimate, I think, but
anyway, we can have room to talk about it. I think
I will check. Yes, I will check for that. I will check for that.
Yeah.
Thank you very much for this. Yeah.
Okay, and one more comment is your when does your sample end?
My sample is from 1985 to 2015.
Yeah, so maybe if there is room to control for global financial crisis. That is why I asked the question. So I don't know. It has changed a lot of things. So you may consider room for controlling for global financial crisis. Yeah, I will stop there. Anyway, we have room to talk further, Francois, on your paper. Thank you very much. Thank you, Prof.
Thank you very much, Desiree.
Thank you, Desiree, much.
Office in SOAS. It was so kind with me, bringing me coffee and so on. And so. Thank you very much.
Thank you.
Yeah.
Thank you both, Francois and Desiree, adding to previous, interactions when at SOAS. And I think those observations you've made are very, very helpful, including even, being able to control for some of the key factors like the global financial crisis, which is, part of the either robustness testing or part of the testing from the in the initial tables for showing the distribution of data. In actual fact, you may find that the initial distribution of data changes when you do before and after the global financial crisis. There is also another important consideration is that, and if you relate this paper, Francois, to the papers we did before with the ESOF, in those papers, it was possible to distinguish between the different types of capital inflows, capital flows. I think in this paper, I see that in the tables, you are able to distinguish between equity and debt as types of capital inflows and looking at further investment. And perhaps, you're absolutely right. These are the two main classes of assets. They all have different risk and return profiles. So there are different classes of assets that you can look at. And beyond that, the other types of capital flows are always difficult to identify. I suppose for many countries in the world, and within the sample of 87, for many countries that could be classified as transition or emerging economies, it will be these two types of capital flows that will matter, either equity or debt.
Okay.
And a footnote could also say that it might be possible, data variability to disaggregate further into the various types of capital flows. But we capture the classes that account for about 80% of the flows into these countries anyway. So you can go deeper into the rest of the, like 20% of the capital flows, but you won't get a lot of mileage unless you are working with, say, US, Canada, UK, and so forth.
Okay. Thank you very much for.
I can see there is another hand up in the Jeffrey. Jeffrey is another scholar following in your footsteps, Francois, and is working on very interesting aspects of looking at credit information behavior, the availability of credit. He's challenging the usual assumptions in most of those models to say that information is available freely and costlessly, and he says it's not. Okay, so please, Jeffrey, go ahead and share your question.
Yeah, thank you, Francois, for the paper. I think it's very important because it covers so many areas in the literature. I think my comment is the area I want to comment. It's been covered by so many people, including Anosi and Rose. But because I think the sectoral allocation of credit is very important in this paper because it's going to explain what your result is really about. And I understand the issue with the data. I was just going to comment whether it's possible for you to look at the annual report of Central Bank of individual country, because I think from 2000 or so, they start to include this sectoral allocation of credit in each country. So if that will help, I mean, you can get as many country as you can put together from the Central Bank of individual country, because getting that will add a lot to the paper. Thank you.
Thank you very much, Jeffrey, for this suggestion.
Yeah. Yes, thank you. Thank you, Francois. And yes, indeed, thank you, Jeffrey, for that insight into the disaggregated data. It may well be the case that he may not be able to cover the 87, but it will give us just a reasonable, maybe smaller sample in which to test for the disaggregation of the of the sectors, disaggregated sectorial work. And actually speaking about the sectors, it's good to see Ahmed Hassan Ahmed from Lafabra, because this morning 10 to 12 we're working on a summary of the new work we are generating, and this is how we identified separately, worked 1 hour separately, worked 1 hour separately, but both of us were able to point out to agriculture and services as the two sectors for financial inclusion. And that's because we are fortunate to have had the disaggregated sectoral data in those two important sectors for inclusive financial development. Yeah. I think the work I keep, whenever I look at your paper and listen to what, it's very, very, very absolutely interesting, because some previous work tried to see whether they can look at this from the level of financial development, but actually it doesn't generate as much interesting results. What drives, say, if you look at various studies of the financial development, what really drives this is the credit growth and credit availability. It's part of the financial inclusion story. It's part of the even digital, revolution in finance. It is credit, basically, the credit which does matter. So that makes your work, absolutely interesting. Okay, so I think let me also check again with the Athena in terms of the chat room. I think that the chat room is very clear, right?
Right,
Athena,
Victor.
the chat room is very clear, and we have generated very useful many. My list here is going beyond the 20 generous comments from so many across the range, from researchers, think tanks, policymakers like Thomas Bwire and Andrew Maba. So maybe I give you 1 minute, Francois, to thank the participants here.
Yeah, I would like to thank all participants and for your comment, suggestion, and question. The honor is mine to have presented here to this high level audience. So thank you very much. Thank you very much, Professor. Thank you.
Okay, okay. Once again, thank you, Francois. I don't know whether I believe that this paper will also go to another, conference, seminar, and then it is in a good shape to be tested on, to test drive it on a good journal, prefer maybe Journal of International Economics. And then see the responses from there. But I think most of the comments will avert or will help you avoid the usual strike blows from recalcitrant referees who will be very keen to shoot down the paper. But I think you have now very good comments to actually build up this strong paper and enhance it to the level of type of presentation. So thank you very much for your availability and your keen interest and in this particular work. But before we close, let me take the opportunity to thank you all participants who have been very generous with your comments and your time in this seminar. We look forward to next week when we have also another exciting presentation, this time on national development banks by Professor Leon Sindikumana from the University of Massachusetts, Amherst. The paper will be available for sharing early tomorrow. And in that next week on Wednesday, same time as today, Leonce will be presenting his research as a part of a research project here at SOAS. And we have been very fortunate to be able to take on board some of the practitioners and leading policymakers on national development banks, and in particular, I can see Madame Lucy Chege, who is here from the Development Bank of South Africa. She's with us now, and she will be speaking, commenting on that paper next week. We'll have also Madame Kampeta Sensionga, who is the CEO of the Rwanda Development Bank. And we also have Madame Patricia Ojangore, who is the CEO of the Uganda Development Bank. And we'll have also one of our scholars, Professor Stephen Griffith-Jones of Columbia University, who will be also among the discussants. So please, I hope that you can find the time to be able to join us and be part of that discussion. So for now, I thank you once again, and bye-bye.